How many times have you placed a trade because MACD showed a crossover, only to see the market instantly reverse and stop you out? Or maybe you ignored the signal because it looked weak, then watched the price explode in the exact direction you expected without you. The truth is, most traditional indicators produce more noise than clarity. But what if there was a tool that cut through the fake outs and showed you precise buy and sell zones that professionals quietly rely on? That's where the two-pole oscillator enters the picture. Let me show you why. Why the two-pole oscillator solves the MACD problem. Traders know the frustration all too well. You wait patiently for hours, sometimes days, and finally MACD flashes what looks like a clear signal. You act on it, but by the time the move actually develops, you're either late to the entry or stopped out as the market fakes the reversal. This is the most common complaint with tools like MACD. It lags the price action, and in a market as fast as crypto or forex, a few candles can mean the difference between a profitable trade and a painful loss. Many traders try to fix this problem by stacking more indicators onto their chart. One adds RSI, averages, maybe even Bollinger Bands, but instead of reducing uncertainty, all those new lines create conflicting signals. RSI says oversold, MACD says bearish, the moving average slopes upward, and now you don't know which one to believe. That's the exact trap most retail traders fall into. Now compare that with what professionals do. They prefer tools that aren't cluttered with lag and don't send mixed messages. They want something that strips out unnecessary noise and highlights the core story of the market: momentum. This is where the two-pole oscillator comes. Unlike traditional setups, it doesn't overwhelm you with extra confirmation signals. It's designed specifically to make market direction easier to read. And that raises a very interesting question. If clarity is so critical, why are retail traders still using tools that constantly mislead them, while professionals quietly employ strategies most people never even hear about? Let's actually set this up together so you can see it in action. Open TradingView and pull up any chart you want. I'll use a 1-hour pair so the examples are easy to follow. Click on indicators at the top. Then type two-pole oscillator into the search bar. Choose the version made by Big Beluga. As soon as it loads, you'll see a distinctive layout appear below your main chart. That's the oscillator window. But to unlock its real power, we need to adjust one quick setting. Double-click the indicator name, go to the Style tab, and enable the option at the bottom called Last Plot. Now a thin line immediately shows up, and that line is crucial. This is the signal line, the backbone of the two-pole oscillator. Think of it as the reference point that tells you whether momentum is gaining strength in one direction or about to shift to the other side. The oscillator itself, which changes color as it moves, will weave above and below this line in real time. When it crosses upward through the line, that's your first sign of bullish momentum gaining control. When it slips downward through the line, bearish momentum is taking over. It's remarkably straightforward, no fuzzy interpretations, no guessing games. And that's not all. The oscillator isn't just a single color. Watch what happens as the market shifts. When momentum leans bullish, the oscillator glows with a distinct change, and when bearish energy dominates, it switches again. The effect is that even at a glance, you can understand which side of the market currently holds the upper hand. This eliminates the need for separate trend confirmation indicators because the visual itself communicates which direction is most probable. Even the best entry signals are worthless if you can't define where you're wrong. This is where the two-pole oscillator stands out again. Built directly into each trade signal is an invalidation level. These appear as dotted markers next to your buy or sell trigger. They're not arbitrary numbers, they function as natural stop-loss zones. Place your risk just beyond those levels, and you've automatically aligned your trade structure with the underlying momentum shift. If price invalidates the signal, you're out quickly with minimal loss. If price respects it, then you're positioned for the move confidently. Let's put that into context with a real example. On this 1-hour chart, the oscillator crossed above the signal line, flipping from bearish to bullish. That was the buy trigger. Immediately, a dotted invalidation marker appeared below the price, giving a clear stop level. If the market dropped back below that line, the trade idea was no longer valid, but instead, price surged higher. The oscillator color stayed bullish, confirming that momentum was intact. The end result was a sharp rally upward, and the trader who followed the signal line plus the invalidation level not only caught the move but did so with confidence that the risk was tightly managed. This is what makes the two-pole oscillator so much more practical compared to old-school tools. It doesn't try to impress you with complicated formulas or dozens of confirmation requirements. It gives you a crossover, a color-coded momentum bar, and a protective invalidation level. That's it. And yet that simple combination addresses the three biggest problems most traders face, as late entries, conflicting signals, and undefined risk. For anyone tired of noisy charts and inconsistent outcomes, this is exactly the kind of clarity that changes trading from a guessing game into a structured process. Conclusion: most beginners don't consistently lose trades because they can't read charts. They lose because they rely on noisy tools like MEXD to disguise momentum instead of revealing it. When signals lag, hesitation and false entries become the norm. The two-pole oscillator fixes that by showing clearly where momentum is real and where it breaks down with invalidation levels. It gives structure to both entries and exits. Open TradingView, load it, and compare its signals next to MACD for yourself. Professionals keep tools like this close because clarity is everything. And now that same clarity is available to you too.